I think any sort of high yield debt is perhaps going to be the sort of nexus of potential problems. Usually when you see a recession potentially developing, the first thing you start to see is a widening of high yield bond spreads over treasuries. And we have been seeing a little bit of that over the past year, but we're pretty far from recession levels. I think currently we're around 4.5% over treasuries in terms of high yield bonds. Normally that would go up towards 7 to 10%. Over before you would see a recession. But the sector that worries me the most is commercial property.
What does history tell us about these tightening cycles? I mean, if we look back at the stop-start type moves that Greenspan brought us, effectively he planted the seeds for every period of excess that came afterwards, whether it was the tech bubble or whether it was the bubble that ran before the Asian currency crisis. Is there a possibility here that the central banks actually handbrake turn if the inflation data keeps coming down quickly enough and that we start to get cuts rather than hikes?
Yeah, that is very possible. I mean, I think one thing that strikes me when I look at central banks around the world is that certain central banks like the US and Canada have brought their policy rates up roughly to the level of inflation. So you could argue that they've at least achieved sort of neutral or somewhat tight monetary policy. When you look here in the United Kingdom, in the Euro area, Norway, Sweden, Australia, rates are like 3% below core inflation. So these countries may be really pumping up inflation.
And just on that, do the central banks have to see inflation return to the policy rate before they cut?
Not necessarily, no. I mean, they can cut for other reasons. For example, here in the United Kingdom, when we had the gilt crisis in September, the central bank didn't cut rates, but they kind of slowed down the pace of increases, and they did a sort of quantitative easing in the midst of a tightening cycle. So central banks may privilege financial stability over fighting inflation in certain circumstances.
So bad news could be good news, in a sense, once again.
Can I just ask you about the UK? You mentioned in the US that there is some comfort to be taken from the fact that everybody's on fixed mortgages. Here in the UK, obviously a very different story, and we've only seen a piece of the mortgage market hit by higher rates so far. When is it going to come to a head here, and how problematic is that going to be?
Well, I think first of all, there is some good news here, which I think is about 68% of households who are homeowners in the UK own their homes outright. So only 32% are actually on mortgages, but of those mortgages, all of them are on what I would describe as a floating rate mortgage. Now here in the UK, we use the term fixed rate, but that's usually fixed for 2 to 5 years. So as those roll in, they're now being remarked at much, much higher rates. And you hear stories of people whose mortgage payments are doubling or tripling, which means I think it's going to really crimp consumer spending growth here in the UK.